I've had enough of this bullshit. Ready to quit crypto. Gold and stocks, baby, buy gold at the galactic top. Look, I don't blame you if you feel like that. Last week hit super hard. Altcoin season, nowhere to be seen, just non-stop pain. Every tweet from Donald Trump seems to shake the market. But before you bail, let's step back and look at the data. Might just tell a completely different story. Look, serious time, Lark. Get serious shirt on. Look, let's start with some key economic indicators that could signal a turnaround, beginning with the next post from Julian Battelle, head of macro research at Global Macro Investor. He posted a few ISM-related charts. The Institute for Supply Management Purchasing Managers Index, we've talked about this many times on the channel before, is a key economic indicator for manufacturing and services. A score of 50 and above means expansion. Anything below means contraction. Well, his first chart shows the ISM together with the percentage of countries with rising OECD CLIs month on month with a 6-month lead time. W2F is all that, Lark. Look, the name means the Organization for Economic Cooperation and Development, the OECD, that thing, right? Composite leading indicator. In a nutshell, the OECD CLI is designed to provide early signals of turning points in business cycles. The chart also shows when past recessions happened. We don't have to discuss all the little nitty-gritty details of it, just look at the chart. Notice how low the CLI percentage dropped during those recessions. It was way, way down, below 20%, maybe even hitting 10% in some cases. Now check it out today. It's sitting near 100% and trending up, not down. Sure, the ISM is below 50, which is not ideal, but markets don't really top until the ISM hits 60 to 65 on average. So definitely not a disaster here, just delayed. Things are taking longer. Another chart he shared is the ISM together with the percentage of central banks cutting rates with a 9-month lead. Now, a quick glance at the chart will tell you that recessions happen when the percentage is 50% or below. Right now, it's near 100% and rising again. Battelle also showed a couple of other ISM charts showing basically the same story. We're nowhere near recession levels, but we're also nowhere near peak levels either. If there's just one ISM chart that you should look at, consider this. According to research published by Mind Growth and authored by investment strategist Jeremy Fielder, the ISM manufacturing PMI averages 52.9 over time. Again, as mentioned, with cycle peaks usually landing between 60 and 65. We're currently under 50. It's been struggling for a long time. The business cycle still has a long way to go, as indicated by the ISM PMI, and will not top until we hit 60 to 65. The peaks at 60 to 65 mark periods of overheating when manufacturing is running super hot before the inevitable cool down. This tends to top the business cycle approximately when all markets galactically top at the same time. Now, the latest September reading came in at 49.1. That might sound like contraction, but it's still miles away from the kind of overheating levels that typically signal a top, and it has been slowly grinding back towards 50. Now, all that makes perfect sense. The ISM tracks manufacturing activity, and when markets are truly in bubble territory, everything is running at full capacity. Factories are busy, orders are backlogged, everyone thinks the good times will just keep going forever. Never gonna end. We'll be able to buy dog coins and get rich easily for infinity. The infinite money glitch. Look, we're nowhere near those kind of vibes in the market right now. I know like gold bugs are euphoric this week and there's been some great moves in the stock market, but we have a long way to go. Now, before we get into the next part of the story, look, guys, you've probably heard of Femex before, but guess what? They're running an insane deal right now. You want to get $3,000? Listen up. This is one of the craziest promotions I've ever seen. If you deposit $10,000 into Femex, they'll literally give you $3,000 back. No bullshit. Simple. Put in $5 grand, $1,500 back. $3,000, $350 back. This is one of the craziest deals I've ever seen, man. It's a super limited time offer. You only have a couple more days to be able to get in on this offer, okay? And of course, Femex Deep Liquidity, secure. I've literally been using them for years and years now. Never let me down. Look, it's available to anyone, anywhere. That's you. You might need a VPN in some cases. Don't miss this very short window to claim this insane deal. Link down below. Go check it out. If you're feeling a bit shaken out by last week's sell-off, here's the bigger picture. The broader market cycle tells a different story than the headlines. In a report published this October, Ryan Dietrich, Carson Group's chief market strategist, he noted that this bull market just turned 3 years old. Happy birthday, bull market. Congratulations. Now, I know it doesn't feel like it, especially after the brutal sell-off for crypto specifically last week. If you're like a hardcore altcoin investor, you're feeling pain right now. I got the bags, man. I'm there with you, I know. But Dietrich's data says the bull market is not done yet. In fact, it has a long way to go. Since World War II, there have been 11 major bull markets with an average lifespan of just over 5 years. That suggests we have at a minimum 2 more years to run just to hit the average length of a bull market, especially as crypto investors start entertaining the idea of an extended cycle. And of course, when you look at everything happening with robotics and AI and all the rest of this stuff, metals, commodities, Donald Trump wanted to run the economy super hot to make America the capital of AI and all that kind of stuff. They're gonna run it hot, man. And get this, well, the current bull run has delivered around 90% gains so far. The average of the last 11 bull markets, listen to this, 191%. So we are shorter than the average bull market right now, and we've put in less gains. So if history rhymes, the traditional market could still be missing another 100% in upside. JP Morgan even said they would have to rise at least another 50% in order for rates to get back to .com levels. So the cycle is far from over according to most of the major data. To make it really clear, Phil Rosen took Dietrich's chart and added an arrow showing exactly where we are today. That one visual alone is incredibly powerful for understanding just how early we are in the cycle. And to put it all in perspective, Dietrich himself said, bull markets are like cruise ships. Once they get moving, they're pretty hard to slow down and even harder to turn around, like the analogy. And since we're talking about cycles, let's zoom out, way out, because beyond the business cycles and the 4-year crypto cycles we're all familiar with, there's something much, much bigger at play. This is what analysts call the secular cycle. The secular what, Lark? Don't say that about my mom. Look, I promise I'm not making this up, okay? Think of it as the mother of all macro trends. These are the mega cycles that can last 10 to 30 years, often containing multiple bull and bear periods within them, but the overall trend is up and to the right. According to Fidelity, the average length is around 21.2 years. The current one started in 2013, though some might argue it was 2009, which is, of course, after we got out of the great financial crisis. You guys know all about that. To understand this a little bit better, let's look at this chart here from the Bank of America, showing all of the secular bear and bull markets. Do you know what's uncanny? If we add 21 years to 2009, that gives us about 2030, about 500 days after the next Bitcoin halving, which tells us that maybe the 4-year cycle, maybe it's not dead yet, but I'm pretty sure it's going to be invalidated, this cycle. What if we add 21 years from 2013? Well, that's 2034. What makes that special? Well, we have to refer to a chart that you probably have seen before, and that's the periods of when to make money chart. This is from a pig farmer in the early 1900s, late 1800s. And scarily accurate so far, even if not always perfect. But it does say that 2034 is a good year, and it's a good time to sell stocks and other assets. Trippy, right? But look, I know most of us, we don't want to wait around 5 or 9 years. Yeah, 9 years, only almost 50, shit. We want near-term probabilities. We want to make money sooner. Check out this chart here from Christian Chafoy and his secular cycle chart. He sees the S&P 500 secular uptrend peaking in 2032 to 2034, matching our 21-year secular cycle from 2009 or 2013. Now he's predicting the next cycle weakness from January to April, May of 2026, which aligns with many forecasts for an extended cycle. So the takeaway, sell by the end of the year. December, January, looking to take profits. Reload your bags on the lows in April next year to ride it back up for another big year at the end of the year. Of course, what's good macro data without looking at GDP? Now, according to the Atlanta Fed's nowcast model, GDP growth for Q3 is tracking at a healthy 3.8%. And that's not all. Other leading indicators are flashing strength too. Take auto sales, for example. Total vehicle sales in the USA rose to 16.4 million in September, up from 16.1 million in August. That's a solid sign of growing consumer confidence and a willingness to spend on big ticket items. This is not the economy going to hell, is it? And it's not just cars. Consumer spending overall increased 0.6% in Q2, showing again, people aren't just scraping by and barely existing, they're spending. Now look, I know some people are doing hard, but some people are always having a hard time. And I know these sound like boring numbers that economists throw around, but they matter. These things matter because a healthy economy where consumers spend and buy cars and shit like that, where companies earn, they expand. When they expand, they hire. Those people get jobs, they get money in their pockets, and they buy fucking dog coins, okay? That's the flywheel. And it drives GDP. And right now, it's still turning very healthily. And I know it's hard to believe because every time you go to social media, it's all doom and gloom and everything's fucked all the time. Oh, we got Trump playing 4D chess here with China and it's everything. World War III is going to happen. But here's the thing. The data doesn't lie. I get it. You're tired of waiting. Tired of being kicked in the balls nonstop if you've been holding any altcoins in this market. The market feels rigged. The headlines are loud. The sentiment's in the gutter. It's been tough. I get it. Especially you're sitting here watching the stocks just rip nonstop. But every bull market climbs a wall of worry. And this one's still climbing. The worry's still there, but we're still climbing. The data is firm, the flywheel's spinning, and the history is saying the best runs begin when most have already walked away. Last week we got a lot of people walk away, which is fucking sucks, but it's the truth. So before you give up, zoom out, breathe, and remember, markets reward patience, not panic. The cycle is not over. From all the data that I can see, the cycle is not over. Far from it, in fact. Thanks for watching.